Here at Vide, one of the most common questions new business owners ask is, how do I pay myself? The answer our accountants typically give depends on how their business is structured, not on how much money is in their bank account. There's a common misconception. For many small business owners, paying yourself does not mean running payroll. In most cases, you're simply moving money from your business bank account to your personal account. But the key is understanding what that transfer represents for tax purposes. If you're a sole proprietor or single member LLC, you do not pay yourself a salary. Instead, you take what's called an owner's draw. That means you transfer money from your business's bank account to your personal account. You can take owner's draws weekly, monthly, or as needed, as long as your business has the cash. In a multi-member LLC or partnership, owners also typically take what are known as distributions rather than paychecks. Distributions are based on your ownership or operating agreement. They are not wages. You're taxed on the share of the business's profit even if you leave the cash in the business. S-corps are where things are fundamentally different. If you own and work in an S-corp, then you must pay yourself a reasonable salary through payroll. That salary is subject to payroll taxes. This structure is popular because it can reduce your self-employment tax, but only if payroll is handled correctly. Lastly, in a C-corp, owners who work in the business are typically paid as if they were employees, i.e. through payroll. Profits may also be paid out as dividends, but those are taxed separately. Remember, your entity type determines how you pay yourself. Most owners are taxed on profit, not the cash they take out of their business. Paying yourself incorrectly can create tax and compliance issues. If you're not sure you're doing this right, that's exactly what we help with at Vide.